Well, good afternoon, all. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us. In today's webinar, we're going to be discussing Canadian index futures. I'm very pleased to have Karen McMeekin, who is the Business Development Manager and Content Provider for Financial Markets with the Montreal Exchange. So, Karen, thank you for joining us. Let me move this over to your slides. I'm going to pass you the ball. So let's get started. Thank you, Karen, for joining us.
Thank you, Cynthia. Good afternoon. I'm Karen McMeekin. As Cynthia mentioned, I'm Business Development Manager and Content Provider at the Montreal Exchange, and I thank you for joining my presentation on Canadian index futures. You'll just bear with me for a moment. My slides just need to load. And for all the lawyers in attendance, here is the mandatory legal disclaimer I am obliged to put. The Montreal Exchange, or MX, is a 140-year-old exchange that since 2008 is owned by the Toronto-based TMX Group. It has been a fully electronic exchange since 2001, dedicated to the development of the Canadian derivatives market. MX is the only standardized financial derivatives exchange in Canada, offering expertise in financial futures and options, information technology, and clearing services. Our four main business lines include financial markets, whose core products can be further categorized into two groups: interest rate derivatives and equity derivatives; information technology, because MX's proprietary trading platform called SOLA is utilized not only by the MX, but by the Boston Options Exchange, Oslo Exchange, and Borsa Italiana's IDEM. We also have the Canadian Derivatives Clearing Corporation, and MX has the majority ownership of 53% in the Boston Options Exchange, which is one of the 13 U.S. options exchanges. Now, I apologize in advance. There might always be a slight delay in the change of slides.
Karen, if I take the ball back, I think I might be able to move those slides a little bit quicker than what you're able to right now. So let me catch up with you, and we'll go on with the show. Go ahead and just let me know when you want me to advance the slide.
Actually, you can advance it right now. Thank you. Perfect. There are many advantages to the MX market model. We have ease of access. There's electronic access through approved participant networks, transparency with real-time anonymous order entry in the electronic order book, visible to all market participants, and a good liquidity, which is supported by a competitive market-making model and liquidity provider incentive programs. Go ahead, Cynthia. MX market participants are primarily made up of clients who can further be broken down into retail or institutional, and professionals, locals who are defined as registered competitive traders, proprietary traders, and market makers. Go ahead, Cynthia. MX currently lists equity options, options on ETFs, currency options, which are options on the US dollar, index derivatives, which includes index futures and options, and interest rate derivatives, which include futures based on interest rates with a time horizon of 1 day to 30 years. Before I get into equity index futures specifically, let's just review what are futures. Now, a pure definition of a futures contract is a derivative instrument or financial contract where a buyer and seller agree to trade a financial instrument or physical commodity for future delivery at a particular price. There is always a zero-sum game. One investor's gain is equivalent to another's loss, so that the net wealth is always equal to zero. There is either physical delivery or cash settlement. Physical delivery, meaning the amount specified in the contract, is delivered by the seller to the exchange and by the exchange to the buyer. However, only a minority of futures contracts end up being delivered. Oh, Cynthia, go back, please. Only a minority of futures contracts end up being delivered because it's more common to close out the position prior to expiration. Cash settlement is actually when the parties settle by paying or receiving the profit or loss at expiration. If not closed before expiration, both parties of a futures contract must fulfill the contract on the settlement date. Go ahead. Investors would use futures for a number of reasons: to fix an anticipated purchase or sale of a commodity or security, to hedge a portfolio, to trade a directional view, or to capitalize on leverage. Equity index futures closely follow the price movement of their respective indices, which are typically referred to as underlying or cash indices. The equity index futures at the MX are the SXF and SXM, whose underlying cash index is the S&P TSX 60. Go ahead. If we look at the index, the S&P TSX 60 tracks the 60 largest companies traded on the TSX, including companies from 10 industry sectors. It represents a market capitalization of $1.4 trillion, which is approximately 73% of Canada's equity market capitalization. Now, looking at the cash market versus the futures market, you will see there are a few key differences. In the cash market, the price reflects the value under current market conditions with immediate settlement and delivery. In the futures market, the price reflects spot price plus the opportunity cost that arises from delayed settlement. This cost of carry, considers costs such as financing, storage, and insurance. With the cash market, participants usually assume the risk of counterparty default, but in the futures market, we have the clearing corporation that assumes that risk. Go ahead. Now, the SXF and SXM contract specifications are quite similar except for one major factor. They both share the same underlying index, the S&P TSX 60 index, but they have two different contract multipliers. The SXF is a standard future, and the multiplier is 200 times the futures value. The SXM is our mini contract, so it's a $50 multiplier times the futures value. They both have contract months of March, June, September, and December, and are both quoted in index points expressed to 2 decimals. The last trading day of either contract is the trading day prior to the final settlement day, which is the third Friday of the contract month. Both contracts are cash settled based on the official opening level of the S&P TSX 60 on the final settlement day. The SXF and SXM contracts are fungible with a 1-to-4 ratio. This means the investor can close out an SXF position with 4 opposite positions in the SXM contract, having the same expiry. This comes with a request for a standard versus mini offset. So for example, if an investor is short one SXF contract, the investor can buy 4 SXM contracts at different intervals and offset the contracts on settlement. For both index futures, we have trading hours of an early session from 6 a.m. to 9:15 Eastern Standard Time, and regular session from 9:30 a.m. to 4:15 p.m. Eastern Standard Time. Now looking at these two contracts individually, we will start with a standard futures contract, the SXF. You would calculate the notional value of this contract by using the $200 multiplier, multiplying 200 times the futures value. So let's say, for example, the futures value is at 800. So it would be 800 times 200 gives you a notional value of 160,000. 1 point or tick equals 10 cents. So therefore, a 1 point move will be plus or minus $20. In our example, if the index increases from 800 to 810 cents, that would be an increase of $20. With the mini futures contract, the SXM, the contract multiplier is 50. So in our same example, with an 800 level, we would do 800 times 50. That gives us 40,000 in notional. For 1 point or tick is also 10 cents, but a 1 point move is plus or minus $5. So 1/4 of the standard future. Go ahead, Cynthia. Now, I have two strategy examples. The first example would be to trade a directional bias on the Canadian economy. So if you want to gain exposure to the Canadian stock market, this would be a great index future strategy. With G7's lowest net debt to GDP ratio and the world's most stable and secure banking system, investing in Canada makes sense. Canada's weight in the MSCI World Index has doubled over the last decade, now the 4th largest constituent and the 2nd fastest growing. So index futures contracts can be used to synthetically create or increase Canadian market exposure of a portfolio in a very cost-effective manner. If you're bullish, you buy futures. Bearish, you sell futures, without the need to process corporate actions or reinvest dividends. There are a lot of advantages to doing this. Efficiency, because it's a faster, more cost-effective way compared to buying and selling equity securities. Flexibility, because you can integrate multiple trading strategies. Leverage, because futures require an initial margin deposit that represents a small percentage of the contract's value. And low transaction costs, with lower trading costs and no management fees generally associated with mutual funds or ETFs. Go ahead. So let's look at an example. Say your view on the market is that the S&P TSX 60 will rise. The index is currently valued at 800. You could buy one SXF or one SXM future to gain exposure. Remember that each 1 point or 10-cent move will result in plus or minus $20 for the SXF and plus or minus $5 for the SXM. So let's compare gaining exposure to the Canadian equity market via these three products. So the price, 800, SXF SXM, and the index tracking ETF would be $20 a unit. So if we look at the contract value, we have 160,000 notional for SXF, 40,000 for SXM, using the $250 multipliers respectively. And with the ETF, we would do $20 times 2,000 ETFs, because it would take 2,000 ETF units to give you the same notional value as one SXM and 8,000 ETF units for the SXF equivalent. Margin requirements, which are subject to revision and may vary by broker, are a lot lower on the index future versus the index tracking ETF. Go ahead, Cynthia. So now looking at the results of an S&P TSX 60 increase. If we look at the increase as a 5% increase, simply put, the price would move up 40 points for the SXF and SXM, and would move up $1 with the index tracking ETF, all of which represents a 5% increase in the index. So the contract value increases by 5%. We have an increase of $8,000 on the SXF, $2,000 on the SXM, and $2,000 on the ETF. In the futures market, leverage refers to having control over large amounts of money using a small amount of capital. So with a small amount of cash, you can enter into a futures position worth much more. That being said, a small change in the futures price can translate into a large profit or loss. Even being long only one contract of SXF or SXM can have a large impact, as illustrated in this table. We see that a 40-point move in the S&P TSX 60 value can generate large profits and large losses, large profits on the upside, and it would generate a large loss on the downside. Looking at a second index futures strategy is how to use index futures to hedge an equity portfolio. As an alternative to options, you can hedge an equity portfolio when anticipating a decline in the market by short selling stock index futures, often used by investors when the market direction is uncertain or volatile to offset downturns. It can be a dynamic hedging strategy that protects degradation of the portfolio value, much like buying index put options. A market correction is predicted once you have compiled a solid stock portfolio for long-term investing. You don't necessarily want long-term insurance, but maybe rather short-term protection. So you can sell index futures just to weather that dip in the market. Covering exposure by selling index futures allows you to generate profits from a fall in the futures market, thereby offsetting any losses in the cash market. By holding SXF or SXM until the correction is over, you can still accrue your dividends on your portfolio stocks. So initiating a short SXF or SXM position helps protect the portfolio without unwinding any equity positions. So let's say our scenario is an investor holds a diversified portfolio and is concerned about short-term risk in the markets. And he's looking to reduce exposure to the markets. Go ahead, Cynthia. So if the investor decides to sell his stocks, he would forgo dividend income, he would incur transaction costs in selling, and there is no doubt going to be tax implications. Hedging with index futures allow investors to maintain all existing positions, continue to receive dividends on the equity portfolio, and not incur any disposition tax. So if we look at a futures hedge example, we'll look at an investor that has a portfolio worth $260,000 of Canadian blue chip stocks. He's looking to hedge risk because he thinks a market correction is coming. So he wants to hedge risk over a 1 to 2 month period and decides to use either SXF or SXM. So to hedge, the investor would sell or short these futures contracts. So how many index futures would you sell? First, you would need to determine the beta of your portfolio. And the beta is the measure of volatility of a security or portfolio compared to the market as a whole. So if your beta is equal to 0, then your securities are not correlated at all to the market. If they're equal to 1, they are perfectly correlated with the market. Most portfolios fall somewhere in between. Less than 1 is a little less correlated, and some tend to have a security more correlated, which would give a beta of greater than 1. So taking your portfolio hedge example with the portfolio value of $260,000 and using the beta of the components, we can calculate the total portfolio beta using an average. So in this case, our average beta of our 10-stock portfolio is 1.36. So how many futures would we sell to protect this portfolio? Well, let's look at the level of the index as being 800, and our portfolio beta is 1.36. You would multiply your portfolio value by the beta and divide it by your notional value. So that would be your $260,000 portfolio times 1.36 portfolio beta and divided by the 800 level times the 200 multiplier, and this is for the SXF. So that would give you 2.21 SXF to sell to hedge this portfolio. If you were looking at the SXM, you would use the same calculation but with the SXM multiplier. So the 260,000 portfolio value times the portfolio beta divided by 800 times the 50 multiplier. So the investor can choose to sell either 2 SXF or 9 SXM contracts to hedge the portfolio, rounding to the nearest contract. So looking at the impact of the SXF hedge, first of all, no hedge will be perfect because we've had to round to the nearest contract. So with the SXF, if we look at an increase, which means it's going against what the investor had predicted. So if instead of going down, the market goes from 800 to 820, well, you would incur a loss on the SXF short of the 2 contracts of $8,000, but your portfolio P&L would continue to increase to $8,840. Same thing if the market would continue to grow to 840 and to 860. You would incur more losses on these short SXF contracts as your portfolio would gain in value. Your net results are still positive, but this protection in place did eat away a little bit at the profits. However, if the investor is correct in his prediction and the market does go down or correct, then the profit he is generating with his short 2 contracts in the SXF market offsets the loss in his portfolio value. So 20 index points down, and he would gain 8,000 in the futures and lose 8,840 in the cash market. Same thing at 760 and 740. So therefore, his net result is a far smaller loss than had he not set up the hedge with the index futures market. Now, if we look at the impact of the SXM hedge, he'd chosen to short 9 contracts on the SXM hedge. Being wrong, it would go against him and it would go up at 820, 840, and 860. We would see losses in the SXM market, continue increase in valuation of his portfolio, and a net result of a very small loss. If the investor is correct, then we would see a net result of positive, because the short 9 contracts in the SXM market would offset and more than compensate for the portfolio value loss in this P&L. Now, as I said, it should be noted that rounding of the number of futures contracts up or down will always result in it being a little off from a perfect hedge. So therefore, go ahead, Cynthia. Therefore, the outcome is the investor has reduced exposure and was protected during a market correction without having to close any positions. During that time, the investor did not have to interrupt the dividend stream. He incurred minimal transaction costs, and there was no tax disposition of any stock holdings. Now, it's clear that index futures are useful tools because key benefits include achieving a broad equity diversification in a single transaction, lower brokerage fees than typically found trading the underlying securities, mitigation of counterparty risk through daily cash settlement of P&L, and centralized clearing by the Canadian Derivatives Clearing Corporation. These were but 2 examples of the practical uses of the index futures. There are several more. And for more information about the SXF and SXM and their different trading strategies, you can always go to www.m-x.ca. I'd be pleased to take any questions.
Well, Karen, what I would like to do right now, because we actually at Interactive Brokers have a slightly different ticker symbol for IB clients to use. So I'm going to move right over into my desktop and show clients here how you can actually access these same contracts via GWS. Now, I have opened up Classic Trader Workstation, and I'm just going to simply type in here TSE 60. Now, this is slightly different from what Karen was talking about, but notice when I click Tab or Enter, I now have that S&P Canada 60 Index Future, and it is using its old name via TWS. Now, notice here when I go into the futures, we'll go out to those December of 2014 contracts, and notice this window here actually allows you to make that contract selection. Now notice the 200 multiplier that Karen had talked about for the large contract and the 50 multiplier for the mini contract. Now I'm going to come down and select all and simply add each of those into my quote monitor screen. Now I'm going to click and drag and separate each of these because I did want you to see that either by using a right click on that particular ticker symbol, I'm going to expand the information and take you into contract detail and the description. And notice here, this is how you'll actually be able to tell them apart. Now notice that this particular, the top contract here, happens to be the SXF with the multiplier of 200. So that gives you the information right there, whether you're trading the full fee or the large contract or the mini contract. Now notice I'll actually go in and do the very same on the second contract that was added, and we'll go into that same description window. And notice here you see the actual SXM, or that ticker symbol that's tradable on the Montréal Exchange, and notice here it is with the 50 multiplier. By the way, while I'm in this window, I also do want to mention the margin requirements. Now, future margin requirements are determined by each exchange and may change periodically. So you may want to come out to this window to see your actual intraday margin requirements as well as any overnight margin requirements here at IB. So a quick look on how to access that information. I'm going to stop my desktop share and take us back over into the main event window, where if you do have any additional questions, go ahead and enter them into the chat panel for Karen at this point. Now also, I do want to mention to you that we have been recording today's session, and access to today's recorded playback will be available and emailed to you directly after today's event. And by the way, whether you're watching us live or via recording, when you do exit the session, you'll actually see Karen's slides pop up in a separate browser window. They are available to you in PDF format, so if you'd like to save or actually print directly from that window, it will be available. Now, by the way, we'll also be posting today's recording on the Interactive Broker website. There's an education menu with a industry-sponsored tab, which is where today's topic will appear. So whether you access us via the direct link that you'll get later on this afternoon or from our website, you can come back and review this recording whenever it's convenient for you. Well, I'm not seeing any questions that have come in at this point, but I do want to let you know if you do have any questions, you can feel free to drop me a line at webinars@interactivebrokers.com. I'll share with Karen and make sure that you get a response back. So thanks, everyone. It looks like that is going to conclude our webinar for today, with a special thanks to the Montreal Exchange for making today's presentation possible. And thanks to you, Karen, for the work that you've put into our event today. With that, we are going to be concluding our event. So want to remind you, simply use the X in the upper right-hand corner of the screen to exit today's presentation. Thanks all. Have a great day, and please remember to trade smart. Thank you.